Okay, you're thinking about owning a construction company. The attractive version is easy to picture. Branded trucks leaving the yard before sunrise. Crews moving across several job sites, cranes lifting steel, and invoices large enough to make almost any ordinary business look small. The economic reality is less obvious. A contractor can be surrounded by equipment, employees, signed contracts, and millions of dollars in reported revenue while still struggling to make payroll. This breakdown will show what construction ownership actually requires, how projects produce revenue where the money disappears, and why cash timing often matters more than the size of the contract. Construction is one of the largest markets in the United States. In May 2026, the Census Bureau estimated that construction spending was running at a seasonally adjusted annual rate, above $2 trillion. That scale explains the attraction, but a large market does not create an easy business. Construction companies usually accept substantial financial responsibility before they receive the money associated with the work. They hire labor, order materials, rent equipment, coordinate subcontractors, obtain insurance, and carry contractual risk while payment moves through owners, architects, lenders, inspectors, and approval systems. The central contradiction of construction ownership. The company may look busy because it has work, yet become weaker because each new project demands more cash. Growth can improve purchasing power and reputation, but it also multiplies payroll, equipment commitments, and estimating exposure. A contractor does not merely sell a finished building. It finances a moving production system whose costs begin today and whose reimbursement may arrive weeks or months later. Before discussing trucks or tools, you have to decide what kind of construction company you are actually buying or creating. A residential remodeler, a commercial general contractor, an electrical subcontractor, a roofing company, and a highway contractor may all work on buildings or infrastructure, but their economics are different. They serve different customers, use different equipment, and face different licensing and insurance requirements. Choosing the lane determines not only what you build, but how you sell, hire, insure, finance, schedule, and absorb risk when projects change. This channel breaks down businesses from the owner's side: entry cost, operating structure, revenue, cash flow, risk, and the difference between impressive sales and money the owner can actually keep. Construction combines fixed costs, variable costs, equipment, labor productivity, financing, regulation, project accounting, credit risk, and contracts that transfer uncertainty. Start with the basic ownership models. A general contractor signs the main agreement with the client and coordinates the entire project. The company may perform some work with its own employees, but it often manages a network of specialty subcontractors. That model can create large revenue and broad responsibility. If the schedule slips, drawings conflict, a trade fails, or the client disputes the work. The general contractor is usually standing in the middle. A specialty contractor focuses on a narrower trade, such as electrical, plumbing, mechanical systems, concrete, fire protection, glazing, excavation, or roofing. It may bill less total revenue, but develop deeper expertise, repeatable crews, and clearer productivity benchmarks. The trade contractor still faces payment and safety risks, yet it may avoid some of the coordination burden carried by the company managing the whole site. Residential work can involve custom homes, production, housing, repairs, additions, or renovations. Commercial work may involve offices, retail, warehouses, hospitals, schools, and mixed-use buildings. Heavy civil contractors build roads, bridges, utilities, transit systems, and public infrastructure. Industrial contractors may work around factories. Remodeling may offer frequent projects and direct customers. But hidden conditions can reveal expensive surprises after demolition begins. There is no single national startup price for a construction company because the answer changes with the trade, state, project size, and ownership model. A small owner-operated repair business might begin with an existing vehicle, portable tools, a license, basic software, and modest working capital. A commercial contractor seeking bonded work may need experienced staff, stronger financial statements, larger insurance limits, office systems, vehicles, safety programs, estimating software, and enough liquidity to support several projects at once. A company that self-performs excavation, concrete, or site work may also need equipment that costs more than the rest of the startup combined. Buying an existing contractor changes the question but does not remove the risk. The buyer may receive employees, customer relationships, equipment, licenses, backlog, and operating history. Yet backlog must be examined contract by contract because signed work can contain weak pricing, unresolved claims, unfavorable terms, or commitments that require more working capital than the buyer expects. Equipment should be valued by condition and usefulness, not by the seller's original purchase price. Receivables require aging and collectibility review. The buyer also needs to understand whether customers are loyal to the company or personally loyal to the departing owner. An acquisition can shorten the path to scale, but it can also transfer old problems. The first cost category is legal access to the market. Contractor licensing is controlled largely by states and local jurisdictions, so requirements vary. Depending on the location and work, the owner may need examinations, documented experience, entity registration, local business licenses, trade licenses, permits, and continuing compliance. Public projects can add prevailing wage rules, certified payroll, registration requirements, disadvantaged business procedures, and detailed procurement standards. The setup determines which contracts the company can lawfully pursue. General liability protects against covered claims involving property damage or bodily injury. Commercial auto covers company vehicles. Workers' compensation addresses covered workplace injuries and is especially important in a high-hazard industry. Builder's risk, inland marine, equipment coverage, professional liability, pollution coverage, cyber coverage, and umbrella limits may be relevant depending on the work. Premiums vary with payroll, trade, claims history, location limits, vehicles, subcontractor controls, and project requirements. Then comes bonding. On federal construction contracts exceeding $150,000, performance and payment bonds are generally required under the federal acquisition rules, subject to limited exceptions. A performance bond protects the government if the contractor fails to fulfill the contract. A payment bond protects qualifying parties supplying labor or material. A surety does not treat this like ordinary insurance. It evaluates the contractor's financial strength, experience, character, working capital, backlog, and ability to complete the work. The premium matters, but bonding capacity matters more, because it can limit the size and total volume of projects the company is able to pursue. DS to the cost most new owners underestimate. Working capital. Tools help perform the job, but cash keeps the job alive. Payroll arrives on a fixed schedule. Fuel is purchased immediately. Suppliers expect payment according to agreed terms. Equipment rent continues while a machine is assigned to the site. Subcontractors submit progress bills. Meanwhile, the contractor may be waiting for inspection, approval, an architect's certification, lender funding, or the client's payment process. A company can report profit under project accounting and still lack the cash required for Friday's payroll. Revenue begins with estimating. The contractor studies drawings, specifications, site conditions, schedule requirements, labor needs, material quantities. Subcontractor quotes, permits, equipment, insurance, overhead, and risk. The estimate becomes a bid and possibly a contract, often before complete information exists. If the estimate misses a scope item, assumes unrealistic productivity, or uses an outdated supplier, quote, the mistake is built into the contract before the first crew arrives. The lowest bid does not always win, particularly where owners use qualifications, safety performance, technical approach, schedule, financial capacity, and past work in addition to price. That is healthy because an unrealistically low bid can be dangerous for both sides. The owner may face delays or failure, while the contractor may be locked into unprofitable work. A disciplined estimator is not trying to produce the smallest number. The goal is to produce the smallest defensible number that still covers scope, overhead, uncertainty, and an appropriate return. Once awarded, each project becomes its own temporary business. Direct costs include field labor, materials, equipment used on the job, subcontractors, permits, temporary facilities, and other expenses tied to that specific project. Indirect project costs can include supervision, site offices, temporary utilities, security, safety, support, and project management. Company overhead exists above the projects: executive salaries, estimators, accounting, rent, software, legal support, insurance administration, vehicles, training, and business development. Profit remains only after all applicable costs. Labor is especially dangerous because the hourly wage is not the hourly cost. An employee's burden may include payroll taxes, workers' compensation, health benefits, retirement contributions, paid leave, training, small tools, safety equipment, and unproductive time. Federal compensation data show why this distinction matters. Benefits form a significant share of private sector employer compensation. Although the exact burden for a construction company depends on its workforce and benefit structure. If an estimator prices labor using only the wage on the paycheck, every productive hour can lose money even when the crew performs exactly as planned. Vitae creates another layer. Suppose a task is estimated at 800 labor hours. If site access is poor, drawings arrive late, materials are staged incorrectly, another trade blocks the area, or the crew needs 1,000 hours. The customer does not automatically owe the difference. Under many contracts, the contractor absorbs it unless the delay or change qualifies for additional compensation. A small percentage change in productivity can erase the expected profit because the project's margin is usually much smaller than its total cost. Equipment creates the same tension between appearance and economics. Owning excavators, lifts, loaders, cranes, and trucks can make a company look established. Ownership also creates depreciation, financing payments, storage, transport, insurance, maintenance, inspections, and repair risk. Renting converts some of those commitments into project-specific expenses and allows access to different machines. But rental rates can become expensive when utilization is high. The question is whether a machine will work enough billable hours to justify its full ownership cost. Tax treatment can affect that calculation, but it should never be the only reason to buy. IRS rules may allow qualifying businesses to expense eligible property under Section 179, subject to taxable income rules, phase-outs, eligibility requirements, and changing annual limits. For tax years beginning in 2026, the published maximum deduction is $2.56 million before the phase-out calculation. That does not mean every contractor receives a deduction equal to every purchase, and a deduction does not make unnecessary equipment free. The company still spends or finances real cash. S can overturn a good estimate even when labor performs well. Concrete, steel, lumber, electrical equipment, mechanical systems, roofing products, and specialty components are exposed to supplier capacity, freight, tariffs, energy prices, manufacturing delays, and design changes. A fixed price contract may leave the contractor responsible for increases unless the agreement includes a workable escalation provision. Experienced owners identify volatile materials, set quote expiration periods, seek early purchasing approval, and negotiate clear rules for extraordinary price movement. Protection depends on precise contract language. Contract structure decides where risk sits. Under a lump sum or fixed price agreement, the contractor promises the defined work for an agreed amount. Efficiency can improve profit, but overruns can reduce it. Under cost-plus arrangements, allowable costs are reimbursed and the contractor receives an agreed fee. Although documentation and cost controls remain essential, a guaranteed maximum price places a ceiling on reimbursable cost, subject to the agreement's exclusions and change procedures. Design-build places design and construction responsibility under one contractual team, potentially reducing handoff disputes while creating broader coordination obligations. Change orders deserve careful treatment because they are not free profit. A legitimate change may arise from revised client requirements, concealed conditions, design conflicts, code issues, or schedule acceleration. The contractor must document what changed, why it was outside the original scope, how it affects cost, and whether it affects time. Unapproved change work can become an expensive receivable that the client disputes. Managed well, change orders prevent donated work. Managed poorly, they create disputes and cash pressure. Payment timing is where accounting and reality separate. Construction invoices are often based on monthly progress, measured work, milestones, or a schedule of values. The invoice may require internal review, project manager approval, architect certification, lender approval, lien waivers, compliance documents, and corrections before cash is released. Federal fixed-price construction rules provide for monthly progress payments, and federal rules allow retainage in certain circumstances, generally capped at 10% under the cited provisions. Private and state practices vary, but the economic effect is similar. Part of the value created can remain unavailable while the contractor continues paying current costs. E is especially painful when expected profit is modest. If a project is expected to earn a single-digit margin, while a meaningful portion of each payment is withheld, the company may complete most of the work without collecting the cash that represents its anticipated profit. Final release can depend on punch list completion, closeout documents, warranties, inspections, claims, and payment confirmation. Retainage is not necessarily a loss, but it behaves like money the contractor must finance until the contractual conditions are satisfied. This is why construction companies rely on work-in-progress reporting. A VIP schedule compares estimated total cost, cost incurred, revenue recognized, billings projected profit, and remaining exposure on every active project. Underbilling occurs when recognized work or cost is ahead of billings. Overbilling occurs when billings are ahead of recognized work. Public construction company filings show these balances as contract assets and contract liabilities, demonstrating that the distinction is not accounting trivia. Underbilling can mean the contractor is financing the customer. Overbilling can help cash flow temporarily, but the money is not automatically profit because future work still has to be completed. Effects far more than fines. In 2026, federal OSHA's maximum penalty is $16,550 for a serious violation and $165,514 for a willful or repeated violation. Although actual penalties depend on the facts, jurisdiction, adjustments, and enforcement process. An incident can also stop work, increase insurance cost, damage employee morale, trigger investigations, harm the company's reputation, and weaken access to future projects. Workers' compensation experience ratings can adjust premiums based on expected loss experience, and some project owners use safety information when qualifying contractors. A safety program is therefore both a human obligation and a financial control. Failures create a similar chain. Rework consumes labor, replacement material, equipment time, supervision, schedule float, and management attention. A mistake can block another trade, delay inspection, extend rentals, and generate disputes. Strong contractors measure rework instead of hiding it inside ordinary labor hours. They use pre-construction reviews, coordination checklists, mock-ups, inspections, and documented quality procedures. Because preventing one serious error can protect the margin from an entire project, growth makes every weakness larger. A contractor with one poorly estimated project may survive by focusing management attention on the problem. A contractor with 20 projects can have the same estimating mistake repeated across the backlog before anyone recognizes the pattern. Expansion also increases accounts receivable, payroll, equipment commitments, supervision, and bonding requirements. Revenue can rise faster than working capital. That is why a company can become less liquid while reporting record sales. Marcus is reviewing a simplified planning model for a commercial contractor with $12 million in annual revenue. The estimate assumes direct project costs of $9.6 million, project and company overhead of $1.68 million, leaving $720,000 before interest, taxes, and any unusual losses. That is a 6% operating result in the model, not an industry promise. Now, one major project suffers $250,000 of unpriced labor inefficiency. Another carries $180,000 of disputed changes. And slow collections add $90,000 of annual interest and financing cost, the apparent $720,000. Cushion falls to $200,000 before taxes, and the company still has equipment payments. Owner compensation decisions and future working capital needs now change the operating behavior. Marcus refuses a bid with unresolved scope, negotiates written approval before performing additional work, bills complete documentation on schedule, and tracks labor production weekly instead of waiting for the project to finish. The company does not need a spectacular increase in revenue. Avoiding one bad contract, collecting legitimate changes, and catching productivity drift early can improve the result more than adding another $1 million of poorly controlled backlog. This is the central ownership lesson. The quality of revenue matters. More than the amount of revenue, owner income must also be separated from company profit. An owner who works as president, estimator, project executive, or superintendent may receive salary for that labor. Distributions are different. They come from available profit and cash, after considering taxes, debt, bonding expectations, upcoming payroll, equipment needs, and working capital. A profitable income statement does not guarantee that all profit can safely leave the business. Sureties, lenders, and project growth may require capital to remain inside the company. The owner's real job changes as the company grows. In a small trade business, the owner may estimate in the evening, supervise during the day, purchase materials, collect receivables, and repair equipment. At a larger general contractor, ownership becomes a system of controls, deciding which projects to pursue, approving risk, hiring managers, monitoring VIP reports, protecting liquidity, maintaining banking and surety relationships, resolving claims, and building a culture that does not hide bad news. The company needs accurate information early. Because construction losses become more expensive, the longer management waits to recognize them. So what does a strong year look like? Projects are selected carefully. Estimates include realistic labor burden and productivity. Material quotes remain valid, or escalation risk is allocated clearly. Change orders are documented. Billing is timely. Safety and quality performance remain stable. Receivables convert to cash without unusual delay. The company earns a reasonable return and retains enough capital to support the next year. A stressed year can contain the same revenue and completely different economics. One estimator misses scope. A supplier delays critical equipment. Labor hours exceed the plan. The client disputes changes. Retainage remains outstanding. Interest grows because the company borrows to cover payroll. A safety event stops work. None of these items needs to equal a huge percentage of total sales. They only need to exceed the thin amount that would otherwise remain as profit. Owning a construction company can be worthwhile. For an operator who respects both building and finance, the business can create skilled jobs, durable assets, valuable customer relationships, and the satisfaction of producing something visible. It can also demand personal guarantees, early mornings, difficult collections, constant hiring, complex contracts, and responsibility for decisions made across many job sites. There is no guaranteed margin, startup budget, owner income, or break-even period that applies to every contractor. This discussion is educational, and the figures and rules are planning references rather than promises. Costs, licensing, bonding, taxes, insurance, labor requirements, and contract law vary by state, project, and company. Anyone evaluating a real construction startup or acquisition should conduct independent due diligence and involve the appropriate professionals, which may include a CPA, construction attorney, lender, insurance advisor, surety professional, an experienced industry operator. The final verdict is not that construction is a bad business. It is that the visible product can distract owners from the invisible company underneath it. Trucks do not create profit by sitting in the yard. Backlog does not create cash merely because contracts are signed. Revenue does not become owner income until labor, materials, subcontractors, overhead, financing, taxes, and future obligations are covered. The contractors that endure are not simply the ones that build well. They are the ones that estimate cautiously, document relentlessly, collect systematically, protect people, recognize losses early, and preserve enough cash to finish what they promised.